This is Chapter 5, Part 1, Revenue Recognition when there's a single and multiple performance obligations. Recently, the revenue recognition rules have changed. There are now 5 guidelines. We're going to go over all of them, and then I'm going to walk you through examples. This is a 4-part series, and I'm going to be walking you through examples so you can see how this works. And the big issue became, when is the service provided, because that's really, and when is it complete, because that's really when the revenue should be booked. And if a sale is made with multiple performance obligations, how do you allocate that? So, what is the core principle for revenue recognition? Well, companies must recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods and services. Now, when is when it transfers to the customer, how much amount the seller is entitled to receive. So this takes into consideration what if there's a chance you won't be paid for all of it. So we have a 5-step process. We're going to go over that first because you really need to understand this in order for you to understand how to work the homework. The first thing you've got to do is identify the contract. Legal rights of seller and customer established. The next thing you need to do is identify the performance obligation, also known as PO. A performance obligation is a promise to transfer a good or service that is distinct, which is the case if the good or services is both. A, capable of being distinct and separately identifiable. You can have a single performance obligation. An example would be you sell a piece of equipment. Or you can have a multiple performance obligations, and this would be you sell a piece of equipment and it includes installation and service for 3 months. That would be multiple. Now, one of the things to remember is that a right of return is not a performance obligation, but instead a variable consideration that will reduce the revenue at the point of sale. Now, the third step is you have to determine the transaction price. Amount seller is entitled to receive from the customer. Then you need to allocate the transaction price. Now, if you have a single performance obligation, you don't have to allocate anything. So if you sold a piece of equipment for $100, $100 is the revenue. But if you have multiple performance obligations, and this is where it gets tricky, you have to allocate a portion to each performance obligation. And then you get to step 5, which is recognize the revenue or as each performance obligation is satisfied. I guess single would be when the obligation is complete, at the point in time or over a period of time. An example of this might be a long-term contract would be, or a service contract over a period of time. At a point in time would be you sold a piece of equipment. Multiple, at whatever time is appropriate for each performance obligation. So now we're going to walk through some examples. The first will be a single obligation, and the next will be multiple obligations. All right, on June 3rd, Hunt Company signed a contract with Anmont to deliver on August 1st merchandising having a selling price of $8,000. Hunt estimates that merchandise with a sales price of $800 will be returned based on previous experience. Now let's apply the 5-step process for recognizing revenue. 1. Identify the contract with the customer. In this case, a contract was signed to provide merchandise to Hunt. Identify the performance obligation. There's only one performance obligation, delivery of the merchandise. Determine the transaction price. In this case, it's $8,000 less an estimate for the right of return. Allocate the transaction price to the performance obligation based on fair market value. The performance obligation will be met upon delivery of the merchandise, and since we only have one, we don't have to worry about allocating the price. Recognize the revenue as each obligation is fulfilled. And in this case, the company will recognize revenue of $8,000 less the estimate for the right of return when the performance obligation is met or upon delivery. Now again, right of return. This has to do with step 3. Exists when the customer can return the good if not satisfied or unable to resell. Another example would be schools when they buy all those textbooks. Viewed as a failure to satisfy the original performance obligation, the seller reduces revenue by the estimated return and either record a liability for cash the seller anticipates refunding to customers when an offsetting entry to a contra revenue account, sales returns, or reduce accounts receivable if the seller has not yet been paid and makes an offsetting entry to a contra asset account, allowance for sales. And I'm going to show you both of those. So again, we're looking at our example, and there's an estimate that $800 will be returned. So if they paid in cash, we're going to assume that we're going to set it up as a liability. We're going to book the $8,000. Cash is $7,200, and then we would have $800, which is a contra sales account for sales returns and allowances. If it's accounts receivable, we would go accounts receivable $8,000, allowance for sales returns and allowance, which is a contra to the balance sheet account, and then we book sales of $7,200. Now, what if there's uncertainty about the variable consideration? An example would be, this is in this same example, but this is a new product for Hunt, and the first time Hunt has sold this product. They have indicated that they will accept all returns. How much revenue should be booked? Well, no revenue should be recognized. Instead, because the seller can't estimate returns, they're going to treat this transaction as if it's placing those goods on consignment with an independent distributor. Now let's take a look at multiple performance obligations. So in this example, Company A signs a contract to provide equipment, including installation and a 2-year service agreement at no extra charge. The equipment sells for $1 million with or without the installation and service agreement, and payment is due 1 month after installation. The installation has a fair market value of $60,000 and the service contract has a value of $40,000 if sold separately. The cost of the equipment is $550. The equipment is delivered on August 1st. Installation is completed on August 1st, and payment is received on September 1st. What are the journal entries? First, we need to identify our performance obligations. So, what are we providing? We're providing equipment, installation, and a service agreement. So we actually have 3 deliverables. Now, we're doing this for $1 million. And the installation has a fair market value of $60,000, and the service contract has a value of $40,000, and in addition, the cost is $550. Now we're going to look at our 5-step process. First, identify the contract with the customer. We have a signed contract, we're fine. And it's to provide equipment, installation, and a 2-year of services. Next, identify the performance obligations. In this case, we have 3: equipment, installation, and 2-year service agreement. Next, we've got to determine the transaction price. And in this case, it's $1 million for all 3. Now we need to allocate the transaction price to the performance obligations based on fair market value. So we're going to use the fair market value to determine percentage of price that is allocated to the 3 obligations. And we're going to recognize revenue as each obligation is fulfilled. So the company will recognize revenue as each of our obligations are performed. And now we're going to walk through that problem. Now we're going to allocate the sales price. So, determine the total fair market value, and determine the percentage of East based on total fair market value. So, our total fair market value is $1,100,000. And we have the equipment at $1 million, we have the installation at $60,000, and we have the service at $40,000. We divide that by the total, and it tells us that the equipment is going to take up 91% of our $1 million, and then 5.4 and 3.6 to installation and services. And always make sure that that percentage equals 100%. Now we're going to allocate the sales price based on the percentages. Equipment is going to equal $1 million times 91. Installation is going to be $1 million times the 0.054, and then we have our services, and again, make sure our total equals the sales price of $1 million. And now we have enough information. So again, this must equal 100%, and this must equal the sales price. Now we're going to do our journal entries because we've done all our calculations. First, when they sign the contract, there's no entry. When the equipment is delivered, that's our first performance obligation. So we're going to book accounts receivable, unearned service revenue for installation, unearned service revenue for service, and sales is going to be recorded at $910,000 on the equipment. We will also then book our cost of goods sold. Next, on August 1st, we're going to do the installation of the equipment. That's our second performance obligation. So we're going to take it out of unearned service revenue and record it as service revenue. Now we have our September 1st payment in full. We have cash and we have accounts receivable. Now at the end of the year, we're going to allocate our service revenue, which is our third performance obligation, being satisfied over time. So we're going to take our $36,000 divided by 2 years or 24 months times 5 months have gone by, gives us $7,500, and we're going to take it out of unearned revenue and book it as service revenue. And that ends part 1 of our 4-part presentation on revenue recognition.